Good morning, everyone. This is Barbara Stoliker with Premier. I'm the National Marketing Director for the LTC brokerage side, and we're here today to talk about long-term care insurance and executive carve-outs, usually small business owners. A couple things I want to mention. The first thing is, please don't type in any questions. I'm the only person here. It's all I can do to handle the webinar as it is, and if I start getting questions, I'm probably going to get off the beaten track. And the second thing is I apologize ahead of time. I've had a cold. I've still got a cough. From now and then you might hear me disappear, and it's only because I've muted you so that you don't have to listen to me cough. So let's move on. So long-term care insurance for the executive and why this is a really good idea. Oh, hold on. In 1996, the Health Insurance Portability and Accountability Act, which we all know as HIPAA, defined long-term care insurance as health and accident insurance. Prior to that, that hadn't been done. Nobody really knew where it fell. So it gave businesses favorable tax treatment for this product. The premiums to the business are treated as a regular medical expense. The benefits are income tax-free, so it's not like DI. If the client takes the deduction up front, the benefits are still going to be tax-free. And it has return of premium options, so there are ways you can move money, or your client can move money from their company to their heirs on a tax-favored basis. So let's look at that. The first thing you need to know is that long-term care premiums paid by an employer for an employee are 100% deductible to the employer. And it doesn't matter what kind of employer it is. And if you're the employer and you're paying the premium, it's 100% deductible to you as long as it's on an employee. If you're the owner of the business and you're paying the premium for yourself and your spouse, that's a different story. We'll get into that a little bit down the line. But right now, all LTC premiums paid by an employer are 100% deductible as a medical expense. And the benefits received, of course, are not taxable to the employee. The premiums are not included in the employee's income, and the employer can discriminate by class. This is something they can't do with other types of health insurance. So what that means to your client is if they want to get insurance just on themselves and then their spouse, or maybe there's 3 owners of the company and they want to buy it only on themselves, they can do that. They do not have to offer this to every single employee like the other health insurance that they get. They do have to just set up a class, so it can be anybody with more than 10 years of service, anybody who makes more than $100,000 a year, anybody who's on the board of directors. They can determine the class, but then once they do that, they have to live by the class. The plans can be voluntary, although I will tell you, voluntary long-term care enrollment is usually pretty dismal. If you want good enrollment, you should try to talk the employer into paying part of the premium. They don't have to pay all or half. They can pay 5% or 10% or whatever it is they feel they want to or can afford, but usually that's the only way you can get good participation, is if the employer is kicking in something. And the premiums can be paid from a health savings account, but they are subject to the age-based limitations, and let me explain what those are. This is something else that HIPAA set down. HIPAA says tax-qualified plans are always going to be subject to the age-based limitations. So whenever you see tax-qualified long-term care premiums, this is what they're talking about. They're talking about the age-based limitations. So if your client is 45 years old in 2017, they can pay for $770 of their long-term care premium from their HSA. And you can see it gets better as you get older. That is also the amount that your client can add to their Schedule A medical expenses on their regular taxes. You know, most people, where it says more than 60 but not more than 70, a lot of those people aren't going to be working, but they have their age-based limitation is $4,090 this year. That's the amount they can add to their Schedule A as a medical expense when they're trying to total up their medical expenses to take a tax deduction. So these are the age-based limitations, and if I refer to them at all, this is what I mean. So let's look at executive carve-out. For tax purposes, LTC premiums are treated just like health insurance premiums. Spouses and dependents can be covered. The policies are fully portable. What these are individual plans that sometimes you can get a discount on depending on which carrier you're going with and whether or not they will offer a discount to employer groups or associations. But these are not true group plans like we're used to, where there's a group certificate and then everybody's covered, and the moment the client leaves the company, they have to take over the premiums from COBRA, and it's really expensive. That's not the way this works. These are individual policies, and when the insured leaves the carrier, they take the policy with them, and they pay the premiums on their own. It's a great way to retain key employees. If you want somebody to stick around, especially if they're in their late 40s and 50s, you can offer them long-term care insurance, and you can offer it on a 10-pay basis. So they'll stay until at least the premiums are paid out. And we'll talk a little bit more about that in a minute too. So here's what's so special. There are limited pay options, and these went away for about 10 or 15 years, but now they're back. You can pay these up in 10 years, so you can have a 10-pay, or you can even have a single pay. Those are back. There's return of premium riders. There's a couple different kinds where you can give all the money that was paid for the policy back to the heirs when that person dies. Single pay, we talked a little bit about that. There's a surrender option. And, of course, the policies are portable. Now, let me talk a little bit about the surrender option. Let's say you're an executive, you're 50 years old, and your employer wants to do something really nice for you, and they buy you a long-term care policy. They pay for 10 years. It's a 10-pay, and it's got a limited return of premium with a surrender option. What that means is that when you die, any premium that has not been used in claims will be returned to your beneficiary. So you've got this great policy that your employer is going to pay up for you. So in 10 years, you retire, you're 60 years old, you've got this paid up policy, your employer's paid it. Let's say your premium was $10,000 a year, the employer's paid $100,000, they've deducted $100,000, and now you're retired and you have this policy. You have two options. You can keep the policy and have coverage for the rest of your life, or you can surrender it. And if you surrender it, you'll get 80% of the money back, $80,000. So that kind of can act like a deferred bonus too. There are a couple ways you can structure that, but that's one way that people do it, and it's pretty attractive to a lot of executives and employers that they can do this for their people. So let's look at the limited pay options, which are, for all intents and purposes, the 10-pay and the single pay. So the pros on this is there's only a limited time where they pay premiums. People like that because they're scared of increases on long-term care insurance. So after the premium payment is done, those premiums are locked in, and the insurance company can never come back and ask for more money. They can be combined with one of those return of premium options. Now there's limited return of premium and full. Limited returns all premium minus claims that have been paid out, so there may or may not be a return. And the full return of premium returns all the premium regardless of claims paid. More pros to this is it can be incentive for the employee to stay. It can be offered to family members, and again, perfect for use in the executive carve-out. If you've got 4 lawyers who own their firm, and they're, 40s, 50s, early 60s, this is something that they might want to do for themselves, pay it up in 10 years and be done, and have the business pay the premium and deduct it 100%. The cons to the limited pay options is that they're normally too expensive for an employee or just a regular Joe buying this on their own. So that's not something that you would normally talk about when you're out there talking about long-term care insurance. It, of course, automatically makes your renewals limited pay too. If you're selling a 10 pay, you're only going to get renewals for 10 years. And if you're selling a single pay, it's one and done. Of course, it's more expensive than a premium that you would pay over your lifetime. So people do get sticker shock, and I'll tell you, it's probably 3 times more. I would say on an average, it's going to be 3 times more than what an annual premium would be. And the premium can change during that payment period. So if you have a 10 pay during those first 10 years, the premium can change. It can't change after the 10-year period where it's paid up. They can never ask you for more money. But it is possible, although very unlikely, that the premium could change in those first 10 years. Now, the return of premium riders, as I mentioned, one of them, the limited, returns premium less claims, and one returns premium regardless of claims. The return of premium is not reported on a 1099 LTC. It's not reported. So if your client, I'm not an accountant, I'm assuming you are an accountant. We don't necessarily want to give tax advice, but if your client is receiving a chunk of money and they're not getting 1099 on it, I'm not sure that they're going to report it. And it's a great way to move money from the firm to the heirs. If your client has a retained earnings problem, they can dump a bunch of money into a long-term care policy with a return of premium rider, and when they die, it will go to their heirs. Of course, it's expensive. It's really expensive. It's not cheap. Keep in mind, what we're talking about here, by the way, primarily is the new long-term care product from NGL, which has brought back the 10 pay, the single pay, the return of premium riders. These things were all available in the early 2000s, and we sold the heck out of them then. And then the bottom fell out in long-term care, and one by one the carriers took those options away. But NGL is back, and NGL is back with these options. So pretty much NGL is the only carrier you're going to find with all of these things available. So of course it is expensive. The dollars that are going to be returned have not earned interest, and the tax laws could change. Right now, the way it stands right now, if you dumped, like I said, $100,000 into this policy, you have the full return of premium, you die, your son or daughter or charity gets that $100,000 back. There's no 1099 generated on that. That could all change, but that's the way it stands today. The single premium options pay things up in one lump sum. Pay it and be done. I will tell you, I would never sell a single premium option without one of the return of premiums on there. It just doesn't make any sense. You don't want your client to dump a bunch of money into this and then die next week and they'd be out all of that money. It just doesn't make sense. So if you're going to do the lump sum, please do one of the return of premium riders on there. But it is available. And there we go. Of course, it's really expensive. The dollars that are being used for this have not returned any interest, and it could be a big red flag to the IRS. Here's an example. Let's say that you're a small business and you're bopping along every year and your medical expenses are $200,000. And then you decide to buy this policy on yourself and your wife. It's a nice policy. It's got a full return of premium on it. The premium is $175,000, single pay, one and done. Now, the next year when you file your taxes, your medical has gone up to $375,000 instead of the $200,000 it's been for the last 10 years. This is not illegal, but it is a red flag to the IRS. I mean, there's just no other way to put it. So although it is not illegal and it is perfectly legal to do it, who wants to take the risk of being audited? So what we've had people do in the past is they amortize that single payment over 10 years, and then it doesn't look nearly as bad and hopefully won't trip any triggers at the IRS. But if your client wanted to take the deduction all in 1 year, they certainly could. Here are some of the Internal Revenue Code sections that you can reference, or you can also give these to your client's accountant if they don't believe you, what you're telling them. And I'm not going to read them to you. You can see what they are. And after the webinar, if you wanted copies of these slides, I'd be more than happy to give them to you. But these are the codes that talk about the things that we're talking about today. 213 is probably the most important one, where it says the benefits received are not taxable to the employee, and that the employer can take the deduction. There are no discrimination rules for employer-funded LTCI coverage. Again, they can carve out, they can offer it to whomever they please, as long as they offer it by class, they create the class, and they live by the class. Long-term care today cannot be offered as part of a cafeteria plan, as Section 125, and frankly, that's not something that we necessarily want in this industry, because once that happens, the executive carve-outs will go away, and mom and pop shops or small businesses traditionally will not be very eager to offer it to all of their employees. So right now, this is kind of a niche market for you. It's a good one, and that's not necessarily something that we want to happen. And there are some limitations on partnerships, S-Corps, and LLCs. I'm not going to talk about that too much right now. C-Corps are the best. And if you were to call us and ask for long-term care quotes, that's one of the questions we'll ask you, is does your client own a company? And it can be any kind of company. We're in the Midwest. We get a lot of farmers who have incorporated their farms, and so they write off their premiums that way. This is the product that does everything we're talking about. It's Essential LTC from NGL. It was just released on the market last August. And if you can't tell already, it was designed to compete with those life/LTC hybrids out there, because those products are pretty much killing the long-term care market, let's be honest. So this is hopefully something that you can use to work around that. NGL is an A-rated carrier. They're new into the market, which is really a good thing for you. They don't have all the junk in the trunk that Genworth has, or Transamerica, or Prudential. Regardless of what people say, being in this business for 20 years is not necessarily a good thing. That's one of the reasons we had all the rate increases we did. It's in 42 states. They brought back lifetime benefits, which is something that we haven't seen in this industry in 10 years. And that reverse combo is the return of premium with the surrender that I talked about a minute ago. NGL is administered by a company called Life Care Assurance. So if you're already contracted with NGL, maybe for their final expense product, and you were to call NGL, you wouldn't find a person at their home office who could talk to you about long-term care. That's not where they're working out of. It's coming out of Woodland Hills, California. Everything is there. The underwriting, the supplies, contracting, questions, that's where you would go. If you didn't come to us, that's where you would go. This is their website, lifecareassurance.com. And I want to bring it up because LifeCare administers long-term care for 13 other carriers. They've been doing it since 1988. Some of the carriers you might recognize are Mass Mutual, the original Allianz, Lincoln Benefit Life, State Life, Allied Life, John Alden. And I'm convinced that these people might be the only ones who know how to price long-term care correctly. Out of all of the products they've had since 1988, only 3 of them have had a rate increase, and the rate increases have been very minimal. So compared to what's going on out there in the marketplace, these people seem to really know what they're doing. So even though it's a new product, and even though it might sound too good to be true, they've done it before. They have a great track record, a good story to tell, and I'm very comfortable that they will be solid going forward. Here's where the product is available. You can see we don't have it, of course, in California or New York or Florida. Those are always the last ones to come through. A little bit up there in the East Coast, we don't have some coverage up there, but most of the country, this product is available. In most of the states, it is not a partnership plan yet, but it will be. There's something called the Compact, which is it's comprised of 38 states, and when you're an insurance carrier, now you can file your product in one place, in the Compact. And if the compact approves it, then bingo, it's already approved in all 38 states. And that's what NGL did. They filed this through the compact. They did not file it as partnership because the states have so many different rules. So once they get most of the states in the country approved, they're going to go back to those compact states, refile it again as partnership, so your clients can be assured that the policy they buy today, although it is not partnership, will be partnership at some time in the future. You know, there's something else that I want to mention here. Another reason that this is a great alternative to LTC or a life insurance hybrid product. First of all, this is true long-term care, so it's tax deductible to the client, which a hybrid would not be. You can custom design the policy. With a hybrid, traditionally, you give the company a bunch of money and they tell you what the death benefit is, and they tell you what your long-term care benefit's going to be. And it might be good and it might be bad. But if you're 55 years old and your policy is going to pay you a $2,500 long-term care benefit for life, that's not going to do you much good in 25 years. So, but a lot of people just accept it because they like the idea that they're not throwing their money down a rat hole, and that they'll be able to, at some point, someone's going to get a benefit. Either they're going to get some long-term care, or when they die, somebody's going to get all the money back, a death benefit. So this product was designed to do that also. So you've got the tax deductibility, you've got the ability to create a policy that is correct for you and what the benefits should pay, and of course it's partnership, because the benefits on a traditional hybrid plan are not partnership qualified. So there's a lot of reasons for your clients to be looking at this product, especially those clients who can afford it, who traditionally might be looking at a hybrid. So, of course, doctors, attorneys, small business owners, you know, you should all get out the yellow pages, if anybody even has yellow pages anymore, and call every small business in your community, because I can almost guarantee you no one knows this. They don't know that the premium is deductible to them as a business expense. They don't know that they can custom create a plan. They don't know that they can pass the money back to their beneficiaries. This will all be news to them, and it's good news. It's something that they want. If you want more information, give us a call. This is our contact info, 800-365-8208. Extension 3012 gets you into LTC. We have a lot of information here on this product. We have tax guides that you can get. You can give them to your client can give them to their accountant. Lots of references and information. I can't take any questions right now, again, because I couldn't answer them all being alone here, but I hope that I hear from you. Thank you for your time. Have a great day.